In this week's video, we'll cover a stock market signal that's only been flashed 9 times in the last 54 years. We're not in the CCM studio this week, just be aware the audio quality may suffer a bit. Seems like quite a while ago, but Wednesday was Fed Day. We came into this week with the following questions. Was the market going to get a version of Fed Chairman Powell that sounded more like Jackson Hole, or more like the near-neutral Powell that spoke on July 27th? Or would he deliver something in between? The basic message at Jackson Hole was a message that we covered several months ago relative to Fed policy and learning the lessons of the 1970s. The text shown on your screen was taken directly from Chairman Powell's comments, and they are not particularly friendly for risk assets. The message delivered at Jackson Hole was in stark contrast to the message that was delivered at Powell's press conference back on July 27th. The markets received the answers to these questions on Wednesday of this week, and all you really need to know, in the very, very early stages of the press conference, Powell said, "My main message has not changed since Jackson Hole," which means all of this still applies. We've covered these topics previously, so we'll move quickly. This is the successful major low that was made in October of 2011. On the other side of the low, you can see the 50-day moving average turns up and for the most part stays up. And after the initial momentum low that was made in August, we had a divergence at the low in October. RSI never dropped back below 36 on the other side of the low. That's in stark contrast to what occurred during a failed rally attempt in 2008. 50-day moving average rolled over in a bearish manner, and after this rally attempt here, RSI dropped below 36 numerous times. If we look at the same data as of the close on Friday, September 23rd, it's leaning in a bearish direction. This is the 50-day moving average here as of the close. This is a zoomed-in look. It appears to be rolling over in an unfriendly manner, and RSI closed well below 36. Doesn't predict anything, it just speaks to probabilities. This is Bitcoin on the way up in 2020 and 2021. Very, very difficult to say that this is not an extremely concerning look. Still have a little bit of possible support in here. After that, not much of anything. Relative to the stock market, the S&P 500 and all the major indices in the U.S. finished well off their intraday lows, which begs the question, was there anything particularly encouraging relative to market breadth at the end of the day? The answer is absolutely positively no. It doesn't mean it's not going to improve next week, but we had a 90% down day in terms of the early read post-close on Friday. This is from Dean Christian's Sentiment Trader. You can find links on his Twitter feed. Here's the handle. Key points here. The leading economic index is now contracting on an annual basis within the context of a bear market. 9 signals. Historically, 12 months later, the outcomes were not particularly favorable in the S&P 500 index. Median outcome was a loss of approximately 13%, with only 38% of the cases positive. There are some significant exceptions. It's Friday evening around 8:40 p.m., thus we will be moving very, very quickly. We've covered this chart in the past. You can make an argument the present day has similarities to this point and this point. It's very, very difficult to make an attempt at a major low when this line here is falling. March low in the S&P 500, June low in the S&P 500 were below that upward sloping trend line. While Friday's session was ugly, the Nasdaq did stay inside of this gap area here. This is the close. It is possible that we could get a bounce in this direction or even a rally attempt near the June low. And as we talked about last week, this is a converging trend look here. So from a probability perspective, we really need to see some significant improvement. Using closing prices, step 1, step 2, step 3. You can make an argument that this is a major topping pattern here, but we're still holding these support levels. We'll see how it plays out next week. This is volume by price over here, these bars relative to the COVID low, The concern is if we give up these levels, somewhat of an air pocket look, it gets a lot easier to fall. But right now, we're still holding these levels. The NASDAQ closed below its 200-week moving average. The longer it stays below, the more concerning it becomes. Weekly momentum here appears to be rolling over below zero. What that means is this is a counter trend move within the context of a downtrend until proven otherwise. There's no bullish momentum divergence here. In fact, price closed a little bit higher than this level here. You can see RSI is a little lower than this level here. This is the broad Dow Jones Composite. The NASDAQ has already visited these levels in 2022. Also a little bit of a concern down here with RSI. Still holding in this general area. Same average looking a little bit further back. This would be our A to B move. We came back to the 38.2% retracement at the June low. If that doesn't hold, it's good to know that the 50% retracement comes right back to this gap area here. And again, this is an area the NASDAQ has already visited in 2022. A little bit better look on the weekly chart for now. We have bounced at an upward sloping 200-week moving average. We have some potential support relatively close by, but as we've mentioned for several weeks now, this is not a particularly encouraging look. Doesn't predict anything, speaks to probabilities. This index bottomed before the stock market, dot-com bust before the stock market, well before the stock market. In the financial crisis, it made a new weekly lower low this week. Relative to recession probabilities, you can make an argument. This look here, somewhat similar to this look here, and this look here. This looks different than anything that we've seen since the low in March of 2009. Economically sensitive airlines, there's a big weekly gap here. We close below these weekly lows here. Dow Jones Industrial Average, June rally, point A to point B. We've taken out all three retracements. On Friday, September 23rd, new intraday low for the year and new closing low for the year. The longer we stay below this level, the more concerning it becomes. Is it possible, even under bearish conditions, that we will come back and try to retest this trend line? Absolutely, positively, yes, it's possible. Dot-com bust, financial crisis, bear market, all things being equal, we would prefer not to see a rollover look with MACD below zero. Momentum not looking particularly encouraging either. The most concerning area on this chart would be from here to here. So it's possible that even if this ratio falls, it could find some support in this area, all to be determined. We've talked about the NASDAQ already visiting this cluster here from 2020. Let's call it the election cluster. Volume by price says there's a possibility that we have an air pocket in this region here, but we still have not exceeded this low. Similar situation here, volume by price. This was your more important area, and we closed well below it. The longer we stay below it, the more relevant it becomes, but we did close above the June low. This is a monthly chart, and the month is not over, but it's pretty easy to say that this looks most similar to this point here. And this is a very, very big drawdown in the market from this rally in Q4 that went into early January of 2009. The S&P 500 dropped all the way into the March 9, 2009 major low in this area here. Really, for the most part, everything that we said about the Dow's daily chart applies. Undercut the June low. Here's a look at closing prices as of Thursday's close, September 22nd. And then we have that similar concern on NYSE here. Somewhat of an air pocket in here, and there's a big gap here, and the NASDAQ has already come down to this area here of potential support. Just good to be aware of. It's very, very possible we're going to bounce back up into this area. Keep an open mind about a wide range of outcomes. Some good, some bad here. Hot knife through butter look with the 200-week moving average we held previously here, so this looks worse. We did try to make a stand, or did make a stand intra-week at this gap here and near this gap here. So it's very, very possible that the market could attempt to bounce or rally next week, but it hasn't shown a lot yet. It's very difficult to make an argument as of the close on September 23rd that this is a good look in here and this is a good look in here. These are not comparisons that you want to be making if you're a stock market bull. Here we said the NYSE Composite made a new closing low and a new intraday low for the year, undercutting the June low. How about market breadth? Do we have a bullish divergence? The answer is no, a new low. Hypothetically, if the ratio undercuts this low here, this is an air pocket region in here. Just good to be aware of. Very, very similar concerns here. Like the S&P 500, the very broad 1500 did not make a new low for the year, and it has not yet undercut this low. As mentioned previously, on Friday, we did get an intraday rally and we closed well off the lows for the S&P 500. However, if we look at a 10-minute chart and we look at RSI, here's Friday's session. RSI made a series of lower highs and for the most part lower lows. So at this point, even from a very short-term perspective, it's difficult to get too excited about that bounce here. The good news is it did hold these levels. Doesn't look particularly good now, but it doesn't say anything about what's going to happen Monday morning. We'll see how it unfolds. It's possible that the market could fall relatively rapidly from where it closed on Friday down to this level here. It's a big difference between possible and certain. The good news is the S&P 500 did not undercut this intraday low from June. It did not close below the June closing low. The bad news would be we did close below all of the gaps shown on your screen. So if we move in this direction next week, what once was support may now act as resistance back in this area here. Notice the 50-day moving average rolling over up here. That's your convergence of the trends. The very, very long-term trend is unequivocally down. The short-term trend has rolled over. Your intermediate-term moving average, or intermediate-term trend, now seems to be aligning with the very long-term trend and the very rapid or shorter-term trend. As always, we're making comments about the chart in front of us. If the chart changes next week, we simply reassess the probabilities. We could show a lot of historical drawdown charts. We're going to show this one. Why? Because it's a very, very recent signal. It's based on the S&P 500's year-to-date performance at the end of August. So on calendar years where the S&P was down 10% or more at the end of August, this is the average and median additional drawdown. Just telling us to keep an open mind that it's very, very possible the S&P could trade down to 3,200 relative to history, and relative to a signal that was just flashed roughly 3 weeks ago. There's a gap in here. The top of this gap comes in at 33.28. Not a prediction in any shape, form, or fashion. Probably fair to say there are more concerning things over here than encouraging things. This is your intermediate term convergence of trends. So the March low on a weekly chart held here in June, closed below it this week. This is your counter trend move in momentum here. Why is it a counter trend move? Because it occurs below the zero line. Now you've got a cross here, which tells us the probability is higher today of this existing downtrend continuing. The keyword is probability. Probably fair to say the look in the present day here is most similar to this look in here and possibly some of these looks in here. This is the dot-com bust bear market. This is the financial crisis bear market. If you're looking for a reason to hope, this is 2011. This is 2015. This is the first time since the rally in June that we had a weekly close below this gap. Good to know where the 200 week is. On Friday, it was at 35.85. Equal weight S&P 500, potential support in this area here. After that, it gets quite a bit more concerning until you get down into this area here. Interest rates, this is the 1980s here. This is the present day here. Key takeaway here is the market really doesn't think the Fed is finished or particularly close to being finished at this point. You can pause your video player here and compare these levels here relative to what's happening in the S&P 500 down here. Hard to say this is an encouraging look on the weekly. You can compare the look of the moving averages for the VIX here to the S&P 500 down here. VIX of VIX weekly 2008 S&P 500. Here's the big spike in that VVIX. Again, very, very difficult to say this is a good look. Here's the momentum here for VVIX. The last time weekly momentum was here, right before the S&P 500 peaked here in 2022. Downward sloping trend line, we broke above it here, S&P 500 rolled over. You can make an argument this is similar to this, and this is similar to this. It doesn't predict anything. Speaks to odds. Pause your video player here. Probably fair to say when the World Technology Index is below its 200-week moving average, concerns increase. This is 2002 here. This is the present day here. Spread of the 10-2 yield curve below that key 50 basis point inversion. Last time we saw something similar right here in the year 2000, and this is what happened in the S&P 500. Not a prediction, but this is not a good look relative to recession probabilities. And yes, we did have a recession in this window here. It's another chart. This looks different than anything that we've seen since March of 09 in here. ARKK relative to defensive staples, rolling over below the zero line momentum, broke the trend line here, lower high, now a lower low. September 23rd close. This looks like a very encouraging bullish breakout for risk. This looks like a very discouraging failed bullish breakout below this key area here. The longer we stay below 41, the more concerning it becomes. We closed under 38 on Friday. We have a divergence in the credit markets. No, we made a new weekly lower low. Good news would be for now, we're still in the neighborhood of that June low on the daily chart. This level here is 72.13 on the June close. We closed at 72.13. Looks different relative to anything we've seen going back to 2016. The longer you stay below these lines, the higher the probability that this is a double top, still in the neighborhood. I believe on one of these charts, we said if you're a stock market bull, that this was pretty encouraging up here, but what you didn't want to see is price slashing through the moving averages and getting to the other side. Unfortunately, that's what it looks like right now. It's still close enough to the moving averages. The more we move here and fill this white space, the more concerning it will become. Not overly concerning yet, but definitely worse than the encouraging look here. We just looked at junk bonds or lower credit quality bonds. These are investment grade bonds. This is not a good look. This is a lower low on the weekly chart. You can see credit bottomed well before the S&P 500 in the financial crisis, and credit bottomed simultaneously with the market for the most part at the COVID low. COVID low here, June low here, below that level and below the June low. All things being equal, if you're a stock market bull, you'd prefer to see price get back into this area here, and you really don't like this look here. If we come down into this area, this would be an area of potential support, all hypothetical. This is what risk on looks like here in late 2020, early 2021. You really don't want to lose this level in here, because if you do, you've got that air pocket look again, still well above this low. This is a very, very encouraging look on equal weight just a few short weeks ago. This looks quite a bit different, still holding this low for now. You can pause your video player here, but this is not the look you want. If you're a stock market bull, you want to look more like this. Another potential air pocket look in here. Relative to the 8-day all the way out to the 138-day in teal, if this isn't a full-bore bullish look, it's very, very close. Another comparison that you don't want to make, this is calendar year 2008. This chart here has been consistent since November of last year. This is where the NASDAQ peaked. If you're a stock market bull, you would love to get into this area here in the coming weeks. SPY relative to IEF, COVID low, support, 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 support below that line. Longer below, more relevant it becomes. This is what risk on looks like. This is what today looks like. This is a weekly chart. Very, very difficult to say that this is a good look relative to this line here. Also not a particularly good look here. As always, making comments about the chart in front of us. This chart looked terrible in here, and then it improved. This chart didn't look particularly encouraging here, and then it improved. Head into Monday with a flexible, unbiased, and open mind. This has been an indecisive look here. If you're a stock market bull, you want to recapture this upward sloping trend line. Also difficult to say that the ratio relative to the 50-month, this is concerning. Longer below, more concerning it becomes. Talked about this a long time ago. S&P 500 bottoms here, if you know your stock market history, in the first couple of weeks of February 2016. Here's your COVID low here. You can make an argument that there could be some pain ahead to get back here. All hypothetical. Right now, this is a mess. Has been for quite some time. Bullish breakout in a risk-on asset. Now it looks like a failed breakout. The good news would be well above these lows. This is where the S&P 500 peaked. This is what today looks like. This is a risk-off look here, risk-off look here. This is what today looks like. Doesn't predict anything, but it's very, very easy to say that this is concerning. It's also concerning that your leaders, such as value, are starting to roll over and join the bearish party. Really, everything that we said about the risk on and then risk off or disappointing flip in ARKK applies to biotech XBI. Still hanging around in the general vicinity, but this looks worse here than this point here or this point here. Here's your converging, rolling over trend look. That would be the bad news. The good news would be still holding the June low. I want to keep an open mind about a wide range of outcomes. This doesn't look too bad. Friday's session, the stocks get hammered. XLP defensive underperformed SPY a little bit. And the 50-day moving average here, this helps the bulls in its present form. If you're a stock market bear, this is the look you want. If you're a stock market bull, this is the look you want. You want to slash through the 200, slash through the 200, S&P 500, S&P 500. Present day look is a confused mess for several months. This is not a good look if you're a trend follower. You don't want to get stuck on any story, including air pocket stories. This ratio so far, this is a lower high relative to these highs. XLY relative to XLP looked quite a bit better Thursday, looks worse now, but still hanging around. Lots of potential support over here. This is the converging trend look. If you're a stock market bull, what you want, this would be your full bore bullish look here. We'll have it in the present day. You can pause your video player here. We've talked about this before. It wouldn't be shocking if the Fed continued to tighten until something breaks. If something breaks, it will be interesting to see how the Fed handles it, given the typical response is to flood the system with liquidity. That's going to be very, very difficult to do in a highly inflationary environment. All to be determined, all hypothetical. Want to keep an open mind walking forward, some good, some not so good. Do valuations currently favor the bulls or the bears? Relative to bear markets and relative to recessions, they favor the bears. Also good to know there's a lot of leverage in the system. How does something break? Because interest rates have come up very, very rapidly. Bullet points from September 9th. This was pre-CPI. We said we were looking for these bullet points for the bullish case, these for the bearish case. There is no question. Post-CPI, bearish, 1. All of this still applies, especially this, and this. The themes from September 2nd are still in play until something improves in a material manner. For clients, we'll continue to leverage this position-traded money market until something material improves on that risk-reward front. For the most part, these were concerning bullet points on September 2nd, and they still apply. Next 3 slides from last week's video, September 16th. We said these were possible bullish catalysts, and we said they were possible bearish catalysts as well. This falls into the bearish catalyst category. These are still relevant from a bull-bear perspective. As we mentioned last week, the economic data to flip the Fed would have to be extremely weak. Not just weak, extremely weak. Again, the message for the most part remains consistent. There's not a lot to get excited about, but it never hurts to be mentally prepared for a bullish flip. If it happens, it's much, much easier to deal with it if you have an open mind. This still applies. This has been a problem. It still is a concern. Last week we talked about 3,700 and 3,600. This week we closed in that range. History says this is potentially relevant as well. And this was important last week. It's even more important as we fall. We don't want to get stuck on any bearish story, any bullish story. We definitely don't want to get stuck on any target level. This is a very wide range of outcomes, including a sharp rally in risk assets if something improves here or here. It's been a very, very difficult year. Bloomberg losses that have snowballed well past 20% for both U.S. bonds and stocks. Experience says during difficult times, if we stick with it, continue to work hard, things should improve. There's always another side. Quote from Bloomberg, I've been in this industry for more than 25 years, and I think the investment environment we're in right now is one of the most complicated or complex environments I've seen in my entire career. Ditto. It's very, very easy to get in a mode where you can never, ever see the other side. It will come at some point. It's all applied last week. It still applies. And as we all know, the only way any of this is going to work, especially from a long-term perspective, is if we head into next week and every week with that flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shivako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.